Hi everyone, JJ here. Welcome back. Well, today I'm going to react to this video of someone, an analyst. I think he's a fund manager. He must be. He's saying that Nvidia is not a good bet long term. What does he mean by this? It presumably assumes he means what's happening right now in the market. It has pulled back 10% just in that last session as I speak, but it's had a massive run up at nearly $1 trillion very, very quickly in just the last few weeks since the stock split. $1 trillion with a capital T. It's huge. So let's see what he's got to say about this.
Shares of Nvidia seeing a sell-off midday, leading to the tech giant's decline today. Our next guest today sees a big concern with Nvidia and its customers. For more, let's welcome in Tim Pagliara, CapWealth Chief Investment Officer. Tim, it is good to see you. So maybe we'll start there, Tim, with Nvidia. You know, investors have piled in. Tim, the street loves this name. I mean, nearly 90% of analysts who cover Nvidia say you should buy it. Even
nearly 90% of analysts say you should buy it, even after this big run up. That's pretty incredible that there's that much consensus on a stock that's run up so much for a start.
Here, but you're cautious about Nvidia. How come?
Well, for the very reason that there's so much consensus. You know, I think it was in a 10-day period, Nvidia added more market cap than Warren Buffett created in Berkshire Hathaway in 60 years. So
that's an incredible stat too. There's some incredible stats based on this thing. If you just look at what's happened, you know, in the light of day, there's some incredible run up in Nvidia. He says Nvidia, so he's saying it incorrectly, which doesn't help his case too much.
So that has to give everybody a little bit of pause about, you know, where things are headed. I was asked in an interview yesterday about which tech company will hit the $4 trillion mark first. And I said, well, I think you got to break that into two parts. You know, which one will hit first, and then which one's going to be sustainable at a $4 trillion company. And I chose Microsoft, but I think Nvidia will probably at this point hit first, just because of the fervor and consensus that everybody thinks that you've got to own that to be successful long term.
It has actually in this last section been knocked off that most valuable company. Microsoft is back up there. So yes, I mean, over the long term, it's been Microsoft and Apple and those companies. Tesla's gone up and down within the top, 5 to 10. And so, yep, sustainably, is it going to keep where it is now or drop back?
Tim, it's Julie here. When you look at Nvidia, what is your extrapolation to the rest of the market? In other words, is what's going on with Nvidia a risk sign for the rest of the market, or do you think that it's just sort of specific to it?
I think it's a little bit of both, but I think, for the value investors, the people that look in places where no one else is looking, I think it's a great opportunity because, you have Nvidia, the market cap of it exceeds energy, it exceeds utilities, it exceeds the value of GE. The last time we went through something like this was in 1998, 1999. Ironically, the darling of that era was Coca-Cola. It had been.
So he's talking about the dot-com bubble here, and that is forgotten. And Warren Buffett owned it at this time. That the market cap, the share price and market cap of Coca-Cola back at that time ran way up. It wasn't just the dot-com bubble. There were a whole bunch of other stocks that ran up too, including Coca-Cola. And Warren Buffett didn't sell that time. He does that if he owns a compounder, he likes a compounder, and there really only been a handful, even for Warren Buffett over the time. He just holds it through thick and thin, through bubbles or not, but he doesn't necessarily buy at the high prices. Just did a video with Tom Lee from Fundstrat, who was kind of advising people, that people have done well by buying at high prices because the market, when it reaches new highs, keeps going. But if you're a value investor, then you like to buy things when the market does take a big dip, or a certain stock takes a dip temporarily.
It had been on an 18% per year compounding, 21% annual increases in dividends. And you could have taken a dozen companies and you could have owned those, or you could have owned Coca-Cola. It's the same thing with Nvidia right now. You can own the entire energy complex, the entire utility complex, General Electric, or you could own Nvidia. You could have 15 Intels, I think is the number, or maybe a little bit more, or you can own Nvidia. So how sustainable that is ultimately with long-term earnings and profits, given the inherent nature of the chip industry, it's not a good bet from my standpoint.
So what he's really talking about here, he's not saying Nvidia is a bad company. He's just saying that the price for even good companies can be too high. Like say if you bought Microsoft during the dot-com bubble, it's at a valuation of $600 billion market cap. This was 1999, 2000, and it took a long time to get back there. And what he's indicating here is that could happen with Nvidia, that it's not sustainable, that if people are buying at high prices, it could go down and take a while to get back, or a Cisco, which took a long time, which never really got back to where it was during the dot-com bubble. So it remains to be seen. Not investment advice. This is just for general education and entertainment purposes. You need to do your own research and seek financial advice. But it's interesting to hear what these people are saying. This is obviously a value fund manager.
Long term, in my experience.
So, Tim, what would be, in your opinion, a better bet, a smarter bet right now? Give us some ideas of where you would be more comfortable committing capital.
Well, I think it's, when you look at artificial intelligence, we look at kind of a picks and shovel type of approach, like in a gold rush, sell the shovels, sell the picks. In this instance, it's the electricity, complex. I mean, no one really talks about it, but, a Google search today compared to a Google search with AI takes 10 to 15 times as much energy. And that hasn't really hit the market yet.
Maybe it hasn't hit the market yet, but in my circles, I've been hearing that people are definitely talking about that. And in tech circles, the massive amount of power it's going to take for these big data centers for AI, especially if it grows, and there's a push to increase all that, and energy will be needed. Sam Altman's been talking about that. He's even got investments in that area. So it is being talked about, Steve Eisman's been talking about it. He talked about AI and the hidden AI play, which was Apple, which is not so secret anymore because it went up after they talked about their AI. But before that, where was Apple? So there's this jockeying for position in terms of that. But everybody does agree that there needs to be a lot of power, and we've got EVs as well. There's a lot of power needed. So, and Warren Buffett's been buying energy oil, traditional energy oil, because that's been sort of a four-letter word. And so there are all these people positioning. And Steve Eisman from The Big Short is pretty bullish on what he calls infrastructure, but he hasn't sort of named any companies. I assume that he does mean, electricity there as well as AI infrastructure. So that the picks and shovels, that's commonly known, that the picks and shovels play. So people do think about these things, but not necessarily at a bullish market level. But, as it broadens out, people will start to think about that as infrastructure starts to grow.
And so I see energy companies, GE Vernova as an example, as really benefiting from that. So you can make money around the edges, I think, in a more sustainable long-term way, because our utility industry, our grid, all of that needed upgrading anyway, and this is just going to accelerate the need for that.
It did need upgrading in the US compared to, say, parts of Asia. People have noticed the difference there when you go to Asia, that things seem newer. And yeah,
a lot of those stocks have been bid up as well this year, and their valuations, one could say, are getting stretched too. But you think there's more upside for the utilities and some of the other sort of infrastructure providers?
Selectively, on a valuation basis, they still look, much cheaper and more sustainable long term. I mean, the building out an energy complex, building the grid, that's a probably a 15, 20-year process at this point. So
Yeah, that is a long process. These things can't be built overnight. And it happened like that during the dot-com bubble. There was a lot of fiber laid, too much, and then it did get soaked up eventually. So could this happen with AI? The infrastructure is different, and people, there's sort of blackouts and brownouts with the power, and the US has difficulties. We've got we've got different kinds of, energy happening from renewables. People are starting to talk about energy, nuclear energy. So, but it is a long-term thing. Things can't be built overnight, and it's sort of an upgrade that's a multi-decade process, as he says.
Well, I think there's a really long runway. Intel, for example, if you look 3 years out, 5 years out, when they get their CapEx starting to churn out revenue, they've got a very, very bright future. They already have a chip that they claim is going to be faster than Nvidia's. There's not, and again, I'm just trying to put a cautionary tale and some reasons where investors should be cautious, because this is where people lose a lot of money. You guys have talked about it. People have been around a long time. Look at Cisco. Cisco had the largest market cap of any company in the world. When these things turn, it's a long recovery. People forget it took 13 years for Microsoft following the peak in 2000 just to get back to where it was. That's a long time for investors that are used to making money every day.
Yeah, and so the tables can turn there. It has happened over and over again. Amazon was like that too, but it was a younger company, and so it can take, when things turn, it can take a decade, as he said, and newer investors won't know that, won't remember that. And even fund managers, as he said, consensus is 90% of owning even at these levels. And I could see that happening. As I said, not investment advice at all. It's just you need to do your own research and have your own thinking on this, or get investment advice. But he is, a value manager, so value investors do think about this and are tending to go in even after, like some bought Amazon after it went down in the bubble, way down in the depths. People like Nick Sleep, investors like Nick Sleep, who were bullish on Amazon after that happened. I think it was 2001, 2002, even later, bought it and did very well. As over the next 10 years, while others bought at the dot-com bubble, it crashed. They sold out and never touched it again. So these things can happen. It pays to look at history. History does tend to rhyme. Anyway, thanks for joining me here today. I'm going to put on the screen a link to a video that YouTube thinks that you should watch next. So go and see that now if you want to. And thanks to everybody for watching or listening. And I'll see you in the next one.